Welcome to Oregon Cash Flow Pro. My name is James Barber, here to help you maximize your cash flow. How are you doing today? Today is Tuesday. That means we're talking IULs. On Thursdays, we talk whole life. If you have any questions, put them in the comments section below, and we will do our best to answer them while we're live. And if you're watching this after the fact, still put your comments down there, and I always try to answer in the comments section to help you on this journey along with us so that you can be the best agent or the best well-informed client that you can be, making sure you're buying the right products that meet your needs. Today, I've got a lot in store for you. We are going to be talking MEC limits, all things MEC. There's two MEC tests. We've got a cash value accumulation test and we've got a guideline premium test. Which one should you use and when? What are the effects of using each of those MEC tests? Should we use an increasing death benefit or a level death benefit? How does our MEC limit change as the policy ages? Those are all the things we're going to be going over today. So stick around and pull up a seat. We've got a lot to learn. Whether you're an agent or a client, this information can be really good to know. If you are an agent and you're watching this, I know a lot of agents watch my channel. Drop a comment in here. I really like having agents learn what I have to put out here, because a lot of what I put out here, you just don't find anywhere else. And a lot of our FMOs, the marketing organizations that contract with us, that contract us with carriers, and even carriers themselves, they spend a lot of time educating you on how to sell products, but they don't educate you about the products, not to the degree that we're doing on this channel. So if you're an agent and you're finding value in this content, put a comment down there. I mean, realistically, I can work with a couple hundred people a year, and we've got millions of people in this country. So I feel really good about helping spread the word on all of this stuff so that people are buying better products. I don't view this as competition. I'm definitely educating the competition, but I think there's enough room out there that we can all do better. And if we're selling better products to people, it's going to be a lot easier for people to be well-informed, buying good products, and then they're going to talk about these great products with other people. And it'll be a lot harder for the public to be misinformed from other people who might have an interest in painting some of these products in a bad light, because all they see is poorly designed policies that don't do very well from a cash growth perspective or meeting whatever other needs the client was trying to meet. So put your comments in there and we'll do the best that we can. All right, so we're talking MEC limits today. I'm going to be showing you some illustrations from. Now, the reason I'm going to be showing you illustrations from is because they're one of the few carriers that has a report inside of their illustration software, their IUL illustration software, that lists every year in the policy what your MEC limit is. Now, I know how the MEC limits work, and it works the same across all the policies, but not every carrier lists that particular report. And since that report is in here, we're going to take a look at it and just know that the same way these MEC limits are calculated apply to all of your IUL policies out there. And there's even some tests that apply to your whole life policy. Okay, so things to be aware of. I do have a nice optimal split design so we're going to be looking at a good designed policy, but the main reason we're looking at this particular one today is because of that report. We're also going to see how the different MEC tests affect our expenses later on in the policy. So the first illustration we're going to start with right here, you can see right here at the top, it says the guideline premium test or the cash value accumulation test is used to qualify your policy as life insurance. This illustration assumes the guideline premium test. So this is our guideline premium test. We're looking at option A, level death benefit, and you can see our face amount is $100,000, and we have an additional protection benefit design of $300,000. This is the blended design that we always like to do in order to reduce the expenses inside of a policy. Now, it does reduce the agent commission. In this case, if you're doing a normal design, all $400,000 would be under the base face amount, and your commission would be based on $400,000 in death benefit. Because we do this split, the commission is going to be based on 100,000 in death benefit. That's why we do this split. It does reduce the commission, but that lowers the expenses inside the policy. All of ours are going to be designed this way today. Okay. This one is designed with a guideline premium test. We have 400,000 in death benefit. This is a 46-year-old male. Not sure why it did 46. I'm not 46 yet. I'm 45. But this rounded me up to 46. So that's just something to be aware of. I'm going to show you each of these designs first, and then we'll scroll through them. Okay, so this is number one. Number two, same 400,000, but we're doing an increasing death benefit. This is also the guideline premium test. Other than that, exact same design as our first one, which was a level death benefit. Then we're going to look at the other choice for a MEC test. That's the cash value accumulation test. And we have a level death benefit. See that right here, level death benefit. And then our fourth design, cash value accumulation test. And we're using the increasing death benefit. So those are our four designs. Those are your four choices on setting your MEC limits. Some people out there really like to use the cash value accumulation test. One of the very popular channels out there, that agent really likes to use the cash value accumulation test and do 5 pays. You pay in for 5 years, and that's it. And paying in for 5 years is a good alternative to spreading out your payments over 7 years. But your MEC limit, when you use the cash value accumulation test, allows you to fund it for 7 years. The reason I mentioned that, I had a client reach out to me and mention this, that this other agent says that's a max funded policy and you do a 5 pay. Well, in my mind, that's not max funded. Max funded would be you put in up to that MEC limit for all 7 years. That's going to be max funded. Now, 5 pay is a very well overfunded design if you have a certain amount of money you want to put into it. But just realize that you have 2 more years if you're using that cash value accumulation test. Now, there's a reason I don't use the cash value accumulation test really ever. You're going to find that out today when we look at the numbers in here and what the impact is on the different MEC tests that we use. So let's go back to our first design. This is our guideline premium test. I'm going to skip down to where our MEC test report, our guideline premium report. So you can see this is the same. This is option A, this is a level death benefit. Now, when we use a level death benefit with the guideline premium test, the guideline level premium is our MEC limit each year in the policy. And it is $8,481 in this case. Next to here, we see our guideline single premium. That's an automatic modified endowment contract. But if you wanted to fund this with 1 pay, put as much into it, and you don't care if it's a MEC, they will let you put in $131,452. You can do that. That would be considered a single premium policy. Now, notice our guideline maximum is also that same number here. It's actually going to stay that number down until year 16. So you can see right here in year 16, it starts to go up. So how the MEC limit is determined in a level death benefit guideline premium policy is $8,481 is the most you can put in each year to keep it from becoming a MEC. I guess I should specify MEC means Modified Endowment Contract. And if you go over the MEC limit, your policy becomes a Modified Endowment Contract. It's no longer considered life insurance. It's not going to get the same benefits of life insurance. It'll still pay out a tax-free death benefit, just like life insurance. But prior to that, if you access the cash values in any way, it's going to get treated on a last in, first out basis, as opposed to life insurance, which gets treated on a first in, first out basis. That means with life insurance, you can actually withdraw your money that you've paid into it. It's called your basis. You can withdraw your basis first, not pay any taxes. After that, you start to withdraw your gains, and you're going to pay some taxes on that. And if you just borrow from it, you don't pay any taxes. With a modified endowment contract, last in, first out, you're going to withdraw those gains first. So you're going to pay taxes right away. And it's income taxes, not capital gains taxes. So you're going to pay income taxes on that money as it comes out. If you don't withdraw it and you just borrow against your policy, use it as collateral, you still pay taxes on it on a last in, first out basis. So you're still going to pay income taxes even though you're borrowing from it. So if you plan on accessing the cash values in your policy, you probably don't want a MEC policy, a Modified Endowment Contract. Okay. So this 8,000, back to what this means, 8,481, that's the limit every year in the policy. You can see this, 8,481 every year in the policy. It stays that. Now, once we get past year 15, notice year 15, the maximum premium, it starts to go up. If we were to do the math, 8,481 times 16, because that's 16 years, equals 135,696. So our MEC limit is going to increase every year by $8,481. So we know by looking at these numbers, this is the maximum we can put in on an average basis. Okay, if your average ends up higher than that, you have a MEC because you're going to violate these numbers over here. If it's below that on an average, that means you have space available. So if you haven't put in any of these monies, if you put in less than this in any given year, this number in this column over here is the maximum you can put in. So you can catch up and have this much. Now that's beginning in year 16. Prior to that, you're going to be subject to these limits each year. It doesn't just add up each year. Okay, it's going to be whatever these numbers are times however many years the policy's been in effect. Now it will let you overfund it to some degree. And that degree has to do with the non-MEC premium limit. So if you look over here, this is actually the limit that you could potentially fund this at if you were able to. 28,015. They will let you do that for the first few years generally. And what we see is by year 5, you will have needed to put in less than this average. This doesn't show us that, but that is the case when we show a particular funding. So we have this one funding, 28,000 a year, you can see for 4 years, and then in year 5, it drops down. It can't go over that 131,452. 131,452, we can't go over that number. So even though it will let us put in during the first 5 years up to this 28,015, which is our 7-pay MEC limit, it's going to drop down because we can't have more than that in here. And it stays at this level for 15 years. If we wanted to keep funding it past that point, it would let us start to put more money in beginning in year 16. Now, in this scenario, I was just illustrating making 10 payments. So it's not going to show payments starting up again after year 16, but it could. It could. Now, this is generally not an optimized policy for being able to put in more money because we're very limited after year 5 on how much money we can get into this policy. If you're just planning on paying for a few years, this can be an okay design because you're not going to violate that MEC limit. So you've got to think when you design your policy or you're buying your policy, do you want the ability to continue funding it longer? And then we're going to weigh the different designs and what do the costs look like? How quickly can we get our money in and see which one works out best for you? Okay. But that's something you're going to want to consider. And if you're young, I tend to default to allowing you to put more money in down the road. Because if these perform the way that we expect them to perform, and we see the stock market go up and down all the time, it's a very emotional roller coaster. You don't get that in these types of policies because we don't lose money in here. So you end up in a situation like where I'm at, where I'm always wanting to put more money into my policies because I know it's not going to go down. I know it's a safe place for me to get my money in. I can borrow it from here and go use it to do something else. I can go borrow it and invest in the stock market or buy real estate. But I want to get it in here because I know it's downside protected. Okay. So this is our level death benefit with a guideline premium test. Let's shift over to an increasing death benefit. This is also again with the guideline premium test. So this is our example number 2. Here's our MEC limits. Should have showed you this on the other one. You can see 28,015. It's the same as our other design was, and it's going to be the same with the next 2 as well. This number didn't change. It's all based on that $400,000 total death benefit that we have. The single premium is the same, but our guideline level premium basically tripled. It didn't quite triple, but it almost tripled when we shifted to an increasing death benefit. Here's our other numbers, not relevant to what we're looking at today. So take a look here. Our guideline level premium, $23,580. Now in this illustration, I had it designed with an increasing death benefit through year 9. And in year 10, it switches to a level death benefit and reduces. So the MEC limit goes away. When I have it switching to the minimum, we're giving up the ability to put more money into this policy. It's not something that happens automatically, but it's something we like to illustrate because it shows in this type of an illustration how we can reduce the expenses. And we're going to see later on what effect that has. But for all intents and purposes, if we left this at an increasing death benefit, we never changed it, this guideline level would continue to be available to be able to max fund it to that level every year in the policy up to age 99. Over here, we see that 131. In the level death benefit, remember it stayed 131 for 15 years, and then it started to go up. Well, here, it goes up after year 5. So this limit is only the limit for those first 5 years. And if we go to year 6 and we take 23,580, we multiply that times 6, we end up with 141,480. So every year, as long as you keep it at an increasing death benefit, your MEC limit goes up by $23,580. If you funded this at anything less than the $23,580, you have the ability to catch up to this number over here. So if you've only put in $15,000 over the course of 7 years, you can dump in an extra $140,000 because this is your limit right here by year 7 with this design. All right. Does that make sense to everybody? Now the MEC premium does not factor in this scenario, except for the first couple of years. So right here on the left, this is the premium outlay. You can see it lets you put in up to that non-MEC number for the first 4 years, and then it's going to drop down. And then it keeps it down here. Because by year 7, we cannot be higher than that average. We can't be higher than this 23,580 average over the course of those 7 years. Now, some carriers, that number is in year 5. In fact, I usually encounter that in most carriers. That's by year 5. Let me see what those numbers are. We got 28,015 at 4 payments, and then add in the 19,392. We're at 131,452. So we're at that number by year 5. It will not let us be past that 131. But then by year 6, the reason it stays down again is because we're subject to that other limit. By year 7, we're subject to this limit. By year 6, we're subject to this limit, which is $10,000 higher than what we had here in year 5. Are you starting to get this? Are you starting to understand how these add up? It's not super important for you, the client, because you can always just call the company and ask them, hey, how much space do I have available? But it's kind of nice to understand. From an agent standpoint, though, it's important that you understand how these work because it's going to help you design better policies based on what your clients tell you their needs and desires are for funding their policy. Okay? These two were both the guideline premium test for our MEC test. Let's take a look at a cash value accumulation test design. This is our third design, cash value accumulation test, level death benefit. Everything else is the same. You can see right here, we don't even see a guideline annual premium listed because it's not a factor in this policy. Doesn't play into it at all. This is the page where it would say the guideline level and the guideline maximum, but it's not here because it doesn't factor in. What we have is our MEC premium, and this allows us to pay in for 7 years. After that, you can't put any more in. It's zero. If you put any more in after 7 years, you have a MEC. You have a Modified Endowment Contract. So if there's any chance that you want to fund this longer than 7 years, you do not want to use that cash value accumulation test. Now, this is a level death benefit. Does it make a difference if we go increasing death benefit with this? Here's our cash value accumulation test, increasing death benefit. Let's go take a look. This is our fourth design, statutory premium. Oh, look, it's the exact same. It goes to zero after year 7. This is an increasing death benefit. Okay. Now, in the increasing death benefit designs, I kept it increasing through year 9 so that we can see what kind of money can we put into this. So we're limited to 196,105 with this cash value accumulation test. If you think you have any chance of putting in more than 196,000, you're going to want to use the other test because it will let you, for the same amount of death benefit, it will let you put in more money over time. Now, you could always just increase the death benefit if you wanted to put more money in over a shorter period of time, over those 7 years. You can just increase the death benefit. That increases your MEC limit, right? But what we're trying to compare here is the different MEC limits, how those affect it, and what kind of flexibility you get with that in the future. Now, there's another impact to the type of MEC test that you choose, and that has to do with net amount at risk. That's how much death benefit do you have to pay for above and beyond the cash value that the insurance company is at risk for. It's called the net amount at risk. And when you use a cash value accumulation test, you have to carry more death benefit throughout the life of the policy. So the big reason why we like to use the guideline premium test instead of the cash value accumulation test is because you're not required to carry as much insurance. Let's take a look at the impact of this. Let's go cash value first. We're going to look at a couple of years of the cash value. So the increasing death benefit, cash value accumulation test, you see over here on the right, the death benefit started out at 400,000 and it goes up. That's the increasing death benefit. You can see it increases through year 10. Here's year 10. And then the death benefit reduces because that was the design that we did. And we're going to see the same thing on the guideline premium test. But that's what an increasing death benefit does. It increases the death benefit as your cash value grows. So here, let's go back. This is our number 3. We can see it's a level death benefit. This is the cash value accumulation test, level death benefit. And that death benefit starts to climb after year 7 because the net amount at risk has to be a certain number. And that's reflected here. The difference between these two values is the amount of insurance you required to have at this point in time. So that's our number 3 design. Number 2, we're going in reverse order here. This is our increasing death benefit, guideline premium test. Increasing death benefit, you can see it's going up the exact same amount that our cash value is going up. And we're able to get a little more money in here over the course of these 9 years. So we put in 212,000 instead of 193. So we got a little bit more money in, not for much longer. We didn't fund it for very much longer than we did in the other scenario. But we did get a little tiny bit more money in there. We're going to see later on what the effect of that is. And it'll make a big difference in the cash accumulation. It'll make a big difference also in the expenses later on. Not getting more money in there, but the type of design that we have, the MEC test we're using. Okay, let's go back to our first design. This is level death benefit, guideline premium test. And by year 5, we were able to get in 131,452, but we weren't able to get in any more than that. So by year 9, when we were able to have 212,000 in our other design and 193 in the other design, we only get 131 in this design. In general, this is the worst type of design that I like to see people get. A level death benefit with a guideline premium test, because we're just not able to get as much money into these policies. This could be a good design if you want a particular death benefit. And you want that death benefit, even though you know you're not going to fund it at a really high level. You're not going to be max funding this higher than these limits here. Okay. In fact, maybe you're funding it at a much, much lower amount. Maybe you're funding it at the 8,000 that the MEC limit is for each year in this policy. But you want to have 400,000 in death benefit. This can be an okay design for that. So there's a place for this potentially, depending on what your funding desires are. Okay. And also in that scenario, I would say if you're going to fund it at a lower level and you don't mind, or you plan on reducing the death benefit later on, this can be an okay design for that, because it's not going to generate the cash value. If you're funding this lower than 131,000, you're going to be paying for more death benefit for a longer period of time. That cash value is likely not going to catch up enough to this death benefit. And you're going to get to an age where that amount of death benefit gets more and more expensive. So you may have the opportunity to reduce it later. That's one scenario where we might use this particular design. I don't encounter that very often. That might just be the clients that I run into, but most of my clients are interested in cash value. We want to optimize that cash value, and we do that with a different design. We do that with the Guideline Premium increasing death benefit. All right, so the last thing we're going to go over today is what is the effects of these MEC limits later on in the policy? How does it affect our expenses? What does the growth look like? Oh yeah, we were going to look at, we looked at the effects here in the early years. What is the effect down the road? Let's take age 75. Here we go, age 75. So in this scenario, and then we'll move on to the expenses after this. Age 75, we put 131,000 in. We're at 673,000. Okay. Not too bad. This was also a max funded design for those first 7 years, or the first 5 years. So not too bad from that perspective. Let's take a quick look at the internal rate of return at age 75. Now we've put in quite a bit less money. When we look at internal rates of return, we always want to consider how much money we've got in there. The way that I like to talk about it is, would you rather get a slightly higher rate of return on a lot less money, or a slightly lower amount of return on a lot more money? And that's often what the consideration is. So here by 75, we're at a 6.15%. Nope, that's the death benefit. Cash value, 5.97% internal rate of return, with the assumption being made in this policy that it's going to grow at a 6.42% growth rate. This will tell us right at the top here. Yeah, right here. 6.42% is the assumed growth rate in this. So at 6.42%, this one has an internal rate of return of 5.97 at age 75. Not too bad, but that is on $131,000. Let's take a look here. This is our Guideline Premium test, increasing death benefit. We're able to get 212,000 in over 9 years. By age 75, we're just over $1 million in here. In the level death benefit, we were at 600 and some odd thousand. So we got 400,000 extra in here by age 75. Now we put in what? 80,000 more dollars into this policy, but we've got 400,000 more in potential growth. How does that affect our internal rate of return? Here we go. By age 75, 6.04. That's a higher internal rate of return on more money. Higher internal rate of return on more money. We're at 5.97 here, 6.04 here. Now, I just picked those numbers randomly. I didn't know how those were going to end up, actually. I hadn't even looked at them before we got on this live stream, and I just showed you right there. We could pick other years and see how they compare. Age 85, 6.23. Age 85, 6.17. So we're still higher. What about earlier? Age 65, 5.64. Age 65, 5.72. We're still higher, even back at age 65. Is there a time where the other one is better? How about 10 years into it? Age 55, 4.69, 4.78. So this one is better in the early years. At what point do we cross over? Maybe 15, 5.37, 5.43. Oh, that looks like where this one becomes better. at 14. This one's at 5.34. This one's at 5.25. Okay, so it actually broke even. It surpassed it sooner than that. 5.2 by year 13, 5.23, 5.1 by year 12, 5.09. Oh, so it was right here at year 11, 4.96 and 4.93. Yeah, so between years 11 and 12, this one got better. This is our second design right here. This is our increasing death benefit. So by year 12, this one had a better internal rate of return on a lot more money. So pretty interesting to see how that works out. All right, let's take a look at the cash value accumulation test. Cash value accumulation test by age 75, we've gotten in 196,000. We're at 934,000. That's $70,000 less than our guideline premium one, in which we funded at what, 196 to 212, 16,000. We funded the other one at 16,000 more. This one's got 70,000 less in cash value by age 75. Let's see what that internal rate of return is. Here we go. By age 75, internal rate of return, 5.93. We're lower. 5.93. Over here, by age 75, this is our guideline premium. This is the design I normally do with all of my policies. Can't think of a time I haven't done this. We're at 6.04. With the cash value accumulation test, we're at 5.93. How about at age 85? 6.03. This one's up to 6.23. The lead is growing in this design the older you get. I wonder why that is. We're going to find out here in a couple of minutes because we're going to look at the expenses. Let's look at the fourth design. This is our increasing death benefit cash value accumulation test by age 75. It should be very close to the other one. The other cash value accumulation test, 931, 188. This one, 934. So about $3,000 more if you do the level death benefit with the cash value accumulation test. The main reason there's a difference there is because in these first few years, you're paying for less death benefit in the level death benefit design. You can see it's holding steady. We're paying for just a little tiny bit more death benefit throughout these 7 years. You can see we're paying for an extra $27,000 in death benefit here, an extra $55,000 here, an extra $86,000 here, an extra $118,000 here. So that little bit just adds up. It's not a very expensive cost. It's a little bit, and the difference is about $3,000 in growth over 30 years. Fairly negligible, okay? But let's see what that internal rate of return looks like. It's going to be a little lower. Again, this is our cash value accumulation test, increasing death benefit. By age 75, we're at 5.91. The other one was at 5.93 or 5.94. By age 75, 5.93. Yeah, I was right. First time, 5.93. So the cash value accumulation test, if you use the level death benefit, you end up in a better place. You just have slightly less death benefit for those first few years than this one does. All right. Let's look at the expenses. And if you stick around, after we go over the expenses, we're going to finish up with the expenses. But there's one more reason why we're going to use the guideline premium test with a particular company. So let's go to the expenses, because this is a big part of why those internal rates of return are so different. So back to our first design. Remember, level death benefit, guideline premium test, $400,000 in death benefit. What we want to look at is our cost of insurance. Okay. I mean, total policy charges is really what we want to take into consideration on all of this stuff, right? Total policy charges. But the reason that we're going to have such a big difference in total policy charges is this cost of insurance. Okay. So our cost of insurance, this is our guideline premium test where we reduce the death benefit after year. Oh, sorry. This is a level death benefit. In the increasing death benefit design, we reduce the death benefit after year 10. So let's go to our expenses down the road. Age 75, we're at $47,000 in total expenses. Our cost of insurance, our expenses in that year, $534. That's made up of $462 for our cost of insurance, $72 to do the documentation. Okay, pretty reasonable. This is our increasing death benefit design. Let's go down to age 75. We're at $64,000 in total expenses. But look at our insurance costs, $680 and $72. Now, this is a lot more in expenses, right? So you might be thinking that other policy was a better deal because we paid less in expenses. But remember, this one had $400,000 more in cash value. $400,000 more in cash value. What's the difference between our cash value and our death benefit? $50,000 in this scenario. What is it over here? $34,000. So that's the difference in cost for our cost of insurance. We're paying for more death benefit on the other one because we have a lot more money that we've made in that policy. That net amount at risk has to be higher. Remember, there has to be a certain amount at risk to the insurance company for this to be considered life insurance. With the guideline premium test, it can be minimized, lower than the cash value accumulation test, but the actual account value is what's going to determine that. There's a table, a factor table that they use to figure out what that amount has to be. Okay. This company in particular has an accumulated value charge earlier in the policy. It goes for 25 years. So the big reason why we have so much more expenses by age 75 is not because of that cost of insurance. That makes a little bit of a difference, but it's actually because we paid more for that accumulated value charge because we had a lot more money in the policy. You can see here, our accumulated value charge was over $2,000 beginning here at age 67 because we had over $600,000 at that time. In the first design, we're back to the first design here, it never gets over $2,000 because we weren't even close to that. We were $200,000 less in accumulated growth. So we don't always just look at the policy charges to determine what's the best design to use. We want to take everything into consideration and understand why these things are doing what they're doing. All right. So total policy charges, our cash value, $673, $47 for our total policy charges at age 75, cash value $673, death benefit $707. With the increasing death benefit design, guideline premium test, we have $64,000 in expenses, but we're over $1 million in cash and $1,053,000 in death benefit. That's looking pretty good. And our expenses are very low in these later years. Let's see what the cash value accumulation test looks like. Cash value accumulation test by age 75. This is a level death benefit, $81,000 in expenses. Look at that, $81,000. What is our cost of insurance? Look at our total cost that year at age 75, almost $4,000. $3,865 is that cost of insurance. What is our cash growth? $934,000. This is $70,000 less than the guideline premium design with an increasing death benefit. Our expenses just in that year, over $3,400 more. Now, $3,300. Let's go back to this one. This is our guideline premium test. We're at $752 in expenses because we were able to reduce that death benefit to $50,000 net amount at risk. With the cash value accumulation test, look at this death benefit. You're paying for almost $300,000 in death benefit. So yeah, you have more death benefit, but do you want that? Do you want more death benefit? Is it worth $70,000 less to you by that time? Maybe, maybe not. Only you get to decide that. But it helps if you know all of these pieces and how they fit together so that you can make sure that this policy is designed right for you. Every year you get older, these expenses are going to keep going up because as your cash value goes up, that net amount at risk goes up a little bit. So let's go a little bit later. Let's go age 85. We're at $10,000 in here. And look at this, between age 78 and 85, 5,000, 5,000, 6, 7, 7, 8, 9. We're at $150,000 in expenses by age 85. At age 75, we were at 81. So we went up by $70,000 just in the expenses. Total cash, $1.724 million. Death benefit, $1,971. We only have to pay for $250,000, just under $250,000 in death benefit here. But that's a $10,000 expense for that year. Where are we at on a guideline premium test? By age 85. Age 85, we're at $84,000 in expenses. It's only $3,800 that year for the death benefit, compared to $10,000 in the other design. We're $70,000 less in expenses. We went up between 64. We went up $20,000 over those 10 years, whereas we went up $70,000 with the cash value accumulation test just over those 10 years. And look at our cash value, $1,925, almost $2 million. Total death benefit just over $2 million. This one, the death benefit isn't even over $2 million in the cash value accumulation test. And the cash value, $200,000 less than that, $250,000 less than that. Are you starting to get this? Are you starting to understand why I advocate for the guideline premium test? My expectation is by the time we get to this point, we are going to have more cash value in a proper design policy than we will total death benefit in a non-optimized policy. Okay, it's really close. It's really close. And we've had more cash value that whole time in the other one. Now we did put in $16,000 extra dollars in these two designs. That's not a whole lot of difference, and we've got hundreds of thousands in cash value accumulation difference. And you have the added flexibility with that guideline premium test that you could keep funding it longer if you wanted to. So there's so many reasons why we go with that one. Let's go to the increasing death benefit with the cash value accumulation test. We're not going to see much difference compared to the other cash value accumulation test. Slightly higher expenses, slightly less cash value. And by age 85, same situation, slightly higher, slightly less. So not much difference between increasing and level, not much difference with the cash value accumulation test. Big difference in growth and what you can fund it at between our guideline premium increasing death benefit and our guideline premium level death benefit. Our level death benefit one, by the time we get to age 85, we're at $61,000 in total expenses, 1.92 in total cash. So the expenses look good. They're $23,000 less than in our increasing design, but we put in more money and we have way more money. We have $700,000 more in the increasing death benefit design. And we funded it at what? $80,000 more. We put $80,000 more into this design than the other one, but we have over $700,000 more in cash value, or right around $700,000. So hopefully that helps. I'm going to go over that one last thing I talked to you about, but drop a comment. Let me know. Did this help you out? Did you guys learn anything today? Anything that you didn't know coming into this? What did you find? What surprised you the most? Put that in the comment. Tell me what surprised you the most. Okay, I'm interested to see what your expectations were compared to reality. So the final, let me switch screens. We're going to go back to our final thoughts on this. Final thoughts. The last reason why I use the guideline premium test, and this is a big one, with Allianz, this is the company that we want to make sure that we use the guideline premium test. With Allianz, if you use the cash value accumulation test, you do not get the overloan protection rider. It's not included. If you use the guideline premium test, it is included. Now, not every carrier does away with the overloan protection rider if you use that cash value accumulation test. In fact, I'm not sure of any other carriers that do. There could be. I just don't deal with other carriers enough. But I know with Allianz, you don't get it. And I do most of my IUL business right now is Allianz because they have the absolute best IUL product on the market with some great index options. So we want to make sure that we're using the guideline premium test with that company. At some point in the future, they may start offering the overloan protection rider with that. There's rumblings about it every once in a while, but I'm not going to hold my breath on that. And I'm definitely not going to get into a contract now that doesn't have that. Remember, our overloan protection rider is a nice pull the ripcord in an emergency type of rider. If you ever have to borrow the money out of your policy, all of it, or either on purpose or accidentally, you accidentally borrow too much, the worst thing that can happen is you end up with a lapsed policy. And not only do you not have any more cash value that you possibly needed to utilize to live on in retirement, but you're going to get hit with a tax bill on top of that if your policy lapses. That's what the overloan protection rider is for. It's meant to make sure that you're not going to end up with that lapsed policy. The insurance company will maintain a small death benefit until you pass away if you have to trigger that rider. It's generally available after age 75. So whether you decide to just take all of your money out via a loan and trigger that overloan protection rider, so you can just walk away and not have to pay the cost of insurance when it starts to get expensive like that. Or if you accidentally do it, you want to make sure you have that rider available just in case. So I don't like to have any policy sold without that if it's available. And it's available on basically every IUL. Your whole life doesn't have it except for one carrier that I'm aware of, and that's Penn Mutual offers an overloan protection rider with that, with their whole life product. But it's generally exclusive to IULs. So if you're getting an IUL, you want to make sure you have that. And with Allianz especially, make sure you're using the right MEC test so that you get that one. And with all of our other IULs, we also want to make sure we're using the right test. Now you know how to design them. I appreciate you guys joining us.
Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.